a little bit more from you, Oliver. There's been some difficulties over the years in the mortgage markets. Very specifically, like when the interest rates go down, but now interest rates go up. Like, what changes do you pay attention to in the real estate markets for whether business is great or you're just trying to figure out your way?
Yeah, good question. The interest rates have a huge impact on the real estate market, obviously. But from our standpoint, it affects things in a couple different ways, right? So, as a real estate investor operator, someone that's going out there buying properties, doing deals, your returns are going to need to stand up to a higher bar of an interest rate, right? So, all deals that may have passed muster in a low interest rate environment just aren't going to work out in a higher interest rate environment. So that's number one. Number two, we're also now evaluating the exit strategy for a deal when when the property gets completed, when the property gets stabilized, or whatever the strategy might be. And so we're evaluating whether a deal can ultimately get paid off based upon some proposed after repair value, or some proposed um, you know debt service coverage ratio that a bank might impose on on an income producing property. So those are two big things, right? And so it's an environment where a lot of deal guys, so to speak, just are having a hard time finding deals that work. And so what does that mean? Is that the deals that do work, it's a much higher competitive environment for those same deals, right?
Okay.
In our world, as a lender, we're all fighting for those to make loans on those deals that do work, right? And so it affects everybody in the ecosystem.
Okay. Well, let me ask you something, a couple of things that you brought up, just for clarity for everybody. You mentioned ARV, after repair value. Like, how does that get figured out? Does a borrower say, hey, this is what I think we're going to end up doing? Do y'all do kind of an underwriting analysis of that? Who determines it for the purposes of your evaluation of a loan?
Yeah, some deals are easier to determine an after repair value than others, right? So residential real estate, very homogenous for the most part, right? So if your borrower's looking to do an infill deal in an established neighborhood, it's fairly easy to find comps, right? They're typically
Mhm.
going to say, "Hey, here's our after repair value. We're going to do our digging and making sure it makes sense, and then ultimately we'll get an appraisal that gives us a formal opinion on that." Now, if it's a commercial piece of real estate, uh, we're going to probably dig a little deeper than just getting an appraisal, and we're probably going to want to go on site to really touch the real estate to make sure that the value makes sense, the lease assumptions make sense, that sort of thing. And depending on who our end investor is, whether it's a private equity firm that's going to buy the loan, or it's a family office that we have a local relationship with, or just some wealthy individual that is looking to deploy some cash, the requirements will differ, on who determines that ARV. Sometimes a formal report is needed, sometimes it's not.
Okay. You had mentioned appraisals. I'd always believed that, so please help me understand that the appraisal is what's it worth today, beyond just what Zillow may hint at, which is generally completely wrong. Will the appraisal also actually say, hey, if you do these things, here's what this after repair value ARV should be?
Yeah, so the appraisal, depending on what you're hiring the appraiser for, as far as a scope, you could hire the appraiser to get what's called an as is appraisal. What is the property worth now before anything has been done to it? And then what is a property going to be worth, assuming that we throw $300,000 of rehab into it, expand the property by 500 feet, put an addition on it, and add add a couple bathrooms or whatever the case might be. And so they'll take a look at that future scope of what that property will end up looking like, and make make a list of comps that are nearby, and have traded within the past 6 to 12 months, and compare it to those values. So depending on the scope of the appraisal, whether it's just an as is or an as is plus an ARV, will dictate what they ultimately, what sort of numbers they pass on to you. And then commercial appraisals are a little different as well, where they're going to take a look at lease comps to and then a local capitalization rate to to determine what the value is going to be based on an income approach.
Okay, and you brought up a word, well, a couple words that I think you're very unique in the space, that literally very few of anybody has access to, and that is private equity firms. Ultimately, you're making the loans, and to some extent just selling them off to private equity. Is that the case? And can you talk a little bit more about that?
Yeah, sure. So when I first got in, prior to getting into the business, I was flipping homes. We were buying real estate, doing value add, reselling them. This was all in the Boston area. We typically did a single family fix and flip, all the way up to converting a multi-unit building into condos. That was the play. When at some point, managing more than 1 or 2 or 5 projects starts to become wieldy. Okay. And then you start, spending your day driving around, checking in on contractors, making sure that they're actually doing the work that that they told you that they were going to do. Oftentimes, it was not always, what was promised. And so that got me to the point of, what, scaling this business is going to be difficult, but the lender that I borrow money from is always getting paid, no matter what. Oftentimes they were getting paid more than I was getting paid, just by looking at the final settlement statement. And so that was around 2010 when I made that decision to get onto the debt side. Since 2010, the industry has grown significantly. Around 2010, most of the money that was being lent for projects, like we're talking about, hard money, private money, whatever the term is that you like to use, it was coming from local lenders, kind of your wealthy retiree that knew the neighborhood and could make a loan very quickly, or it was local firms that was typically well capitalized, and just lent locally to borrowers that they knew. Since then, the market has significantly changed due to the attractiveness of the space, and it now includes Wall Street players, private equity firms, institutional investors, life insurance companies, and these loans are now being securitized and traded as bonds. Okay, so it's grown up significantly over the past 15 years. However, there is still an appetite, for it's still room for everyone in this space. Private equity occupies a certain loan profile that they're very good at doing, but they're not very good at the loan with a story. Okay. The loan with a story is something that resembles this guy has bad credit, but he has a clear exit strategy, and the loan to value ratio is very, very low, so there's a high likelihood that the loan will pay off without problems.
And when you say very, very low, like what are you really looking at for your underwriting? And does it kind of come in buckets, or like, hey, if it's not, 50% loan to value, we don't touch it, or 50% ARV? Like, how do you create that scope for your own business?
Yeah, so for our fund that we have set up, it's a max of 65 LTV. So anything below 65 loan to value ratio is considered conservative in our space. Some of the more aggressive lenders in our space will typically go up to as high as 90 LTV, 90% loan to value.